Welcome back to another episode of the MD Investor, the channel where we talk personal finance, getting that financial education that you never got. You know you didn't get it. Teaching our children so we can break the cycle of generational poverty. Today I'm starting a new series all about dividends. All about dividends. I remember growing up, the only time I saw dividends is when we were playing Monopoly. And you throw the dice, you'd end up on a community chest, you pick up the card, the bank pays you dividends of $15. The bank will give you $15. But it wasn't really real, it was a game. But little did I know that dividends were real. Other people knew about dividends. Different zip codes, different circles. But I didn't know about dividends. So today is all about dividends. We're going to educate ourselves. First question. What are dividends? Great question. I'm glad you asked. Dividends are money given to you by certain companies. It comes from their earnings, right? You have to make money to be able to give money out. So dividends are income that comes from certain companies, from their profit, and they return some of that money, that profit, to the owner. As a stockholder, you are an owner of the company. So, for example, if you own one share of McDonald's, McDonald's pays a dividend. Right now, I think it may be about $1.28, I think, per quarter, meaning every 3 months, you'd get $1.28 for each share of McDonald's stock you own. You're like, well, and that's basically what it is. Profits going back to the owners. That's why you want to own stocks, equity, ownership. It's good to eat a Big Mac, but it's good when they pay you money and you can buy a Big Mac. Anyhow, so that's basically what dividends are. Not all companies pay a dividend, right? The stock market is separated in like two different types of companies. One they call growth company. So there will be companies in the upward trajectory. They're new, they're gaining market share customers, they're growing, they're reinvesting in their business, and they're growing. When those companies make a profit, they do not give the profit out to the stockholders or the owners. That money is kept and held on by the company to grow the business. So research and development, acquisition, merger of other companies, new products, new services, to get more market share, more customers, to grow, get more valuable, pay down your debt. These are growth companies. Examples would be Tesla, Google. They don't pay dividends. And then you have companies that are dividend paying companies. They're more mature. So after 20, 30, 40 years, they've been around a long time. They have grown as big as potentially they can get. They have thousands and thousands of shares, and they have dominated their space, and they've crushed all the competition. And the example would be McDonald's. There's really nobody for McDonald's to compete with. They're so big, and they dominate their space. What else can they do? So with the money, they return some of the profits to the owners or the shareholders, hence the dividend. Okay? So that's essentially what dividends are. So growth companies do not pay a dividend because they think they can do better things with the profit than give it out to shareholders, meaning they could grow the business. And then if they grow the business, then they get more valuable, then your stock will go up in value or appreciate in value. So imagine you bought one share of a company for $100. Instead of giving you back $5 a year, say at a 5% dividend, they keep the $5, grow the business, and now the stock or the company becomes more valuable. Now your $100 that you bought the stock for, the company is now worth $200. So you have now made $100, right? Because you bought it at 100 and it's now worth $200. If you were to sell, you would you would realize a $100 gain, or a gain of 100%, right? So that's what dividends are. So we've talked about what dividends are. We've talked about who pays them, mainly more established companies. So Pepsi pay the dividend, Coca-Cola pay the dividend, Home Depot pay the dividend. So like I said, in other videos, we're going to get into the nitty gritty, but that suffice right now. So why are dividends so attractive? Well, we kind of already said it. It's passive income. And on this channel, we're all about passive income. Dividends are passive income. They are income coming to you without you having to trade your time for money. So they're very attractive because it is income coming to you without you having to work for it or trade your time for it. You can't say that about your job, right? Your job doesn't pay you unless you show up, right? So this is another stream of income. This is why people love dividend. That's why all over YouTube you see dividend, dividend. People love dividend. They love the idea of getting money without putting their time. So really what you have to put in to build a dividend portfolio is you have to put your money into it. So dividends are great. Make no doubt about it. Dividends are excellent. And they're a great way to supplement your income, or if your dividend income is big enough to actually replace your income. Don't worry, we're going to get all into that in another time. But dividends are not guaranteed. Dividends are not guaranteed. Dividends have to be approved by the board of directors of the company. So they look at all the metrics, what's going on with the company, and then they approve the dividend. In times of financial crisis, such as a pandemic, when the business is not doing so great, when debt is mounting and revenue is going down, the board of directors will decide, hey, we may have to suspend the dividend. We saw that in the travel industry. Carnival had to suspend, cut its dividend because of the situation that was going on, right? So because of the worldwide situation that was going on in 2020, Carnival had to cut its dividend. So this is a real life example, and other companies did it too. This is a real life example to show that dividends are not guaranteed. There are things you can do to look at the history and give you confidence, like, oh, they've been paying a dividend for X amount of years, but we had a once in a 100-year situation happen. But keep in mind, dividends are not guaranteed. When you begin to start studying about dividend, one thing you'll come across is dividend yield. Doing your research, you're going to come across dividend yield. If you type into Yahoo Finance or any of these sites, any stock charts, you're going to see yield. What they're talking about is the dividend yield, right? Whenever you see yield, that means that company pays the dividend. If there's a dashed line and there's no yield, that means that company does not pay a dividend. So dividend yield is very important. That's one of the criteria we're going to look at when you're building your dividend portfolio, is the yield. Because the yield will let you know how much money you will receive annually from owning this company. So you could have a 2% yield, a 3% yield, a 4% yield, right? If this company is paying you a 5% yield, it's more income then a company pay you a 2% yield, right? And the higher the yield, the less money you have to put in to get the same amount of income. Okay, so a company paying 5% yield will give you $5 for every $100 you have invested. A company that only pays 2.5% yield will only give you $2.50 for every $100 you have invested. So you'd have to put in twice the amount of money, twice the capital. With a company yielding 2.5% compared to the amount of money you'd have to put in for a company yielding 5%. That's how the yield makes a difference. So the amount of money you get is going to be inversely proportional to the yield. So low yield, you have to put more money in. High yield, you only have to put a lower amount of money because the yield is high. The dividend yield is the amount of money in dividends you're getting annually divided by the share price of the stock. So if a company is paying you $5 annually in dividend and the share price is $100, so that would be $5 in dividend divided by $100. That's a 5% dividend yield. Most companies pay the dividend 4 times a year or quarterly. So the schedule would be January, April, July, October. Or you can a company may pay February, May, August, and November. Or you could pay on the 3, 6, 9, 12, right? So the third month is March, June, September, or December. So that's how they generally pay. You do have some companies that pay monthly. Most of them are in the real estate space. So you have monthly dividend company. A lot of European companies will pay dividends semi-annually, only twice a year, right? So dividend yield is very important, but we don't go chasing yield. Let me show you why. We said a company that's paying you $5 in dividends per year and the share price is $100 is a 5% yielder, right? They're paying $5 per year, 4 times a year. So $1.25 4 times a year. Okay, $5 over 100 is 5% yield. Okay. If that share price, so the dividend yield you can see can be affected by 2 different factors. The dividend yield can be affected by the dividend, which is the numerator, and the dividend yield can also be affected by the denominator, which is the share price. Staying with that same example, if the dividend yield can go down if the dividends go down. So if, for example, instead of paying you $5 a year, they now cut the dividend, and the dividends are now only $1 4 times a year. So now instead of $5 a year, they're only giving you $4 a year, and the share price stays the same. $4 over 100, your dividend yield is now only 4% instead of 5%. Your dividend yield can also go down if your dividends stay the same. So $5, still getting $5 a year, but your share price goes up. So instead of $100 a share, the company goes up in value, and now it's $200 per share. So 5 over 200, instead of being 5%, is now only a 2.5% yield. That's not a bad thing, right? Because your share price has doubled, right? You've made unrealized gains. Your share price is doubled. So that's not bad. For new people coming in, they have to buy at the $200 per share. But if you had the company already at 100, you have seen appreciation. When they come in buying at $200 a share and it's only paying $5, they're going to realize a 2.5% yield. But because you had the stock at $100, the $5, because you had the stock at 100, because you bought the stock for $100, you're still seeing a 5% yield. Yeah, you're still seeing a 5% yield because you bought it at $100. So the dividend yield is very important. But so we say that the dividend yield can be affected by the dividend and the share price, right? Now, the dividend yield can increase, again, by the same factors. The dividend yield can increase if the dividends go up and the share price remain the same. Stay with our example. The dividend yield can go up if our share price stayed at $100 per share, but our dividend payout, instead of $5 a year, our dividend payout is now $10 per year. Now the $10 over the $100 is now our dividend yield is now 10%. 10 over 100, our dividend yield is now 10%. That's great. They'll raise the dividend, and they must have raised the dividend for a good reason, right? Because we said the dividends are coming from the profits most of the time. Sometimes they could do some fancy economic gymnastics, such as taking on debt. But we'll do other videos where you can look into it and realize what's going on. So if the dividend payout is going up, that's usually a sign that the company is economically strong. And usually when that happens, the share price usually goes up. But in this example, just for you to understand, the dividend yield can go up if the dividends go up and the price stays the same. The dividend yield can also go up if the dividends stay the same $5 a year, but the share price drops. Continue with our example. If our dividend payout is $5 a year, same $5 a year, but our share price drops from $100 to $50. So now instead of $5 over 100 for 5%, it's now $5 over 50. And the dividend yield is going to double. And now it's going to be 10%. Right? So you see how we got a 10% dividend yield in both cases? 10% dividend yield if the dividends go from $5 to $10 or doubled, and the share price stays the same at 100, 10 over 100. And you could also get a 10% dividend yield if the dividend $5 stayed the same, but the share price gets cut in half to $50. In the second example we just said, you would have to look, why is the share price dropping? And there may be some fundamental reasons, which we could look into other metrics and see why. Maybe the earnings are going down. Maybe the revenues are going down. Maybe there's some scandal or something going on. Maybe there's a worldwide health crisis. Why is the share price dropping? Right? So the dividend yield is probably one of the top metric you want to look at, but we got to understand. That's why they say don't go chasing yields, because you could fall into what they call a yield trap. The dividend yield is high because the share price is dropping, and the dividend does not reflect it as of yet. Right? Keep that in mind. When you have dividend stocks and they pay you a dividend, there's two main things you can do with your dividend. I guess you could say three. One, you can take the dividend as cash. The dividend gets transferred to your checking account that's linked to your brokerage account. Money comes in, and you can use that money to buy, but you can use that money to buy Big Macs. You can use that money to pay your car note. You can use that money to buy food, go out to dinner. You can use that money for vacation. You can use your money for whatever. The other thing you can do with your dividend is you can reinvest it into this company that gave you the dividend, what they call a dividend reinvestment plan, popularly known as a DRIP, DRIP, dividend reinvestment plan. And that's a popular way to build up your share count. So keeping with our example, McDonald's pays you your dividend. And you take the dividend they give you and buy more shares of McDonald's stocks. So then the next time the dividend comes around, you'll have more stocks earning more dividends. So then you could reinvest it and buy more stock. That's the dividend snowball technique. Dividend snowball technique. You could also take the dividend that you get paid from one company, so McDonald's, and use it to buy stock in another company. You can do that as well, right? Maybe your position in McDonald's is big enough, right? Maybe you have 10,000 shares. Let's say, for example, as we project into the future, and you say, 10,000 shares is enough. That's enough. I want to build up another position that's very low. So you may take the dividend from McDonald's and buy shares of another stock, Home Depot, or whatever, that you don't have enough. You're trying to build that position, right? So that is another thing you could do with the dividend. So guys, we're going to do more videos along this line to increase that financial IQ. So guys, hopefully guys you enjoyed this video. Learn some information about dividend stocks. We're going to continue with information about building out a dividend portfolio. This is going to lay the groundwork, because having another stream of income, it is excellent, especially when it's passive. So continue to learn, increase the financial IQ. Give me a thumbs up, give me a subscription, and send this video to friends or family that want to become financially independent. And until next time, continue to command your money to grow. MD Investor out.